Hello, good afternoon and good morning. Welcome to HYCM's workshop with myself, Giles Coghlan, Chief Currency Analyst. I do hope everybody's well. Abdi, good to see you. Good to see you here, Gabriel, Mihai, good to have you as always. Muhedin, Salman, Farhad, Alaritza. Good to have some familiar names as well as some newcomers here today. Just as folks are signing in, remember, as we talk about different entries, exits, different instruments, we're doing this from an educational perspective. The whole idea of these workshops, you see how I'm making my trading decisions, and you can see the decisions I'm sort of making, and hopefully that helps inform your decision-making process. It's not a signal trading service or an invitation to trade, as you can imagine. Market conditions are constantly changing, so it's impossible to really give an outlook that isn't updated. Don't forget, today we will be looking at, just make sure that this is okay now. Today's the workshop, and in the workshop we look at a specific data point and consider how markets might trade it. Now, what's very interesting about this Eurozone data is we have seen some pretty significant moves in Eurozone data today. We had Spanish inflation data out yesterday, a bit weaker, French data weaker, German data weaker, and ECB's Villeroy, for instance, was saying that he thinks the peak could be in for French inflation. Now, those disinflationary forces mean bond traders will step back in, and we are seeing some bids in the bond market as a result. I'll talk us through that and show you what that might mean for tomorrow and what opportunities they are. We'll also look at some the non-farm payroll on Friday, as well as the US ISM and JOLTS data as well. So someone spoke to me in the week and I said I would look at that for them, so I will keep my word. Okay, so let's just assess where we are. So number one, look at the Spanish data that came in yesterday. I'll just maximize this screen. What you can see, year on year, 3.2%, down from the 4.1% prior and down from the 3.5% forecast. Big tick. Core inflation for Spain, 6.1, down from 6.3 expected. And the month on month was as expected. Now, when you add that to what we've seen today, French producer price inflation significantly lower, so producers are under less price pressure. And we see the headline is 6% down from 6.9%, and that's 6.4% forecast. And if we just take a look at the, let's just take a look at the French data. French inflation data, and you know, we've got the French inflation data coming in at 5.1%, and look at that, that's a decent drop lower. So the market's really happy about that. And we've also seen French PPI down for April 7% year on year from 13.4%, excellent. And German inflation data is just showing a little bit of a drop as well. You can see the German composite, the Brandenburg region, Hesse, generally just coming in a little bit lower, showing that peak. And you can see the headline harmonized inflation print, 6.3 versus 6.8% expected. Excellent. Year on year, 6.1% down from 6.5. So if we just take a look at Germany, we can see the latest inflation, a lovely little drop. This is what markets want to see. This is what the ECB want to see, because remember, this means that central banks can be less aggressive in hiking interest rates. So all of this has meant that the ECB, now you can see they're less likely to raise interest rates further. And now interest rate expectations have fallen. And we can see now that it's 91% chance that the ECB are seen hiking by just 25 basis points in the middle of this month, on the next month on the 15th of June. So bottom line, that's good news. And one of the sort of big giveaways that we saw on this was in the bond market. Now, if you look at bond yields, what happens is when bond yields start going lower, the yields are lowering because the bonds are being bought. And what this is showing us, and if you look at German bonds, you can see that German bonds have been sold heavily today, trying to break through this near-term region. And what this is showing in the German bond, there isn't a European bond, so the German bond is used as a proxy for the European bond. And what this is saying is that bonds are coming back into focus and they're attractive. There's a very close link between bonds and interest rates. Essentially, when bond traders are seeing higher interest rates, you typically sell bonds, which means the yield rises. So if you go back to like the start of this year, you know, as markets were expecting higher interest rates, right, you saw the bonds being sold off, right? We're now seeing some buyers step back in, and that makes sense because inflation is less of a problem. And you can see this across major markets. If disinflationary forces are here, if inflation has peaked, then bonds are attractive again, okay, and their yield will fall. So that's what's going on. Now, this is helpful for us for tomorrow for the following reasons. You see here the euro US dollar. It's been sold off, right, throughout the session. We found sellers, which is what you'd expect as you've had the higher, as you've had the lower inflation, less expectations of the ECB hiking interest rates. That is euro negative. Now, because the ECB will not need to hike interest rates so much. So what we're looking for here is there's two potential tradable opportunities I can see. And this is for the data we have tomorrow. So coming up at 10, we have the Eurozone inflation data. Now, when you're looking at this inflation data, right, what we're looking for here is an out of consensus miss or an out of consensus beat. So already markets are going to be expecting Eurozone headline to fall. Now, in order to see further euro weakness, what we'd need to see is we'd need to see the headline coming in below the minimum expectations. So you can see the year-on-year data, minimum expectations is 6%. So if the headline comes in below 6% and the core comes in below minimum expectations below 5.3, and the CPI flash comes in below 1,236, and the month-on-month comes in below 0.3%, or certainly below 0.4%, in that case, markets will say, aha, Eurozone inflation has peaked, right? So you look, it's expected to come to 6.3% down from 7%. So if we just look at the euro area, right, and you look at the inflation that's expected, you can see 7 was the prior, and it's expected to come in at 6.3. Now, if we see another big drop, say this comes in below market's minimum expectations of 6, comes in, but you know, 5.9 or something, great news. Everyone will be like, hooray. The inflationary problem is finally receding. That will be euro selling. Now look at the core as well. The core has been quite sticky. And you notice how the core has been, you know, still moving up. A lot of central bankers throughout the world have been commenting on the core being a problem. And you can see quickly, can't you? Look, the headline, you know, has been dropping considerably. If we just go back to the headline. Okay, good. Right direction, right direction, right direction. The core, oh, wrong direction, wrong direction, wrong direction. So looking at what's expected, 5.3% will be below market's minimum expectations. So if this comes in below 5.3 and the headline comes in below 6, then what markets will think is great. The inflation battle is being won, and you'd expect to find euro weakness. Okay, so expect euro weakness out of a big print. Now, the go-to currency pair to trade that would be euro US dollar. And what I would personally do is I just look for going down to a key pivot point, right? Look for a key pivot point and look to take profit there. We could potentially see this 200 exponential moving average breaking lower. If we did, then that does open up a way to retest that 1.0600 region. and then below that is 1.0550 in that near-term support level. So watch out for that. But you also have to be worried about the dollar aspect, because the euro-US dollar is inversely correlated to the dollar index. So if the dollar gains, euro-US dollar falls, and if the dollar falls, euro-US dollar gains. So also look at risk sentiment. If risk sentiment turns very, very positive and we see lots of dollar weakness, then that could nullify the trade, or it could make it just mitigate your targets. So just bear that dollar factor in mind. Now, there's also another opportunity, and if you think about it, this will make complete sense. Throughout the week, everyone's been going, oh, great, Spanish inflation falling, hooray, the ECB won't need to be so aggressive. French inflation falling, hooray. German inflation falling, hooray. Italy showed a little bit of a peak, but Germany and France are the two biggest sort of contributors to the Eurozone, so that's a big tick. And everyone thinks, well, therefore this must fall. But here's the best opportunity for tomorrow. If the inflation data comes in above market's maximum expectation, so say the headline comes in at 7.2, moving in the wrong direction, and the core comes in at 6%, moving in the wrong direction, right? And if you think about it with the core, so if it comes in at 6%, then what are investors going to say? They're going to say, oh no, core inflation is a problem. The ECB will have to act aggressively to act. So the best opportunity, if this comes in very high, that will contradict some of that recent euro weakness we've seen, and we'd likely see a snap higher in the euro-US dollar. So, the simplest expression of that would be, I'd expect to find dollar buyers, and hey ho, great, we're on that 200 exponential moving average, so that's an easy place to potentially define risk, and looking for a run back up to that 10750 region, okay? And if not there, just managing it with pivot points as you go and having those pivot points as the target. So that's what I'm expecting. Now, I'm going to look at some other options here for us, so that we're ahead of some other events. There are some other events coming up, and a couple I want to look at. So let's look at what we're doing. We've got a couple of Fed speakers coming up later on in the session. Let's just take this whole week. So, and let me just check I've got everything I need here. Right. So we've got a couple of Fed speakers coming up. We've got the US jobs. Right, now this is going to be key today, right? Because the labor market is really, really important. And let me show you why. This is HYCM's blog, of which I provide nearly all the material, virtually all certainly all the daily analysis I provide. Now, if you look at this thing called the Phillips curve, this is what the Fed Reserve's looking at, right? Now, the way it works is this. When typical economic monetary theory goes like this, when you have lots of people unemployed, right? So when there's a high unemployment level, inflation pressures are low. Why? Because employees are desperate for a job, so they'll work for less, and there's less money in the economy. So low unemployment equals low inflation. The opposite is also held to be true, right? Yeah, I'll talk about debt ceiling talk, Salman. I'll deal with that. Now, look at the unemployment rate. When the unemployment rate is very low, in other words, lots of people are in work, then inflation is expected to be high. Why? Because workers are able to command higher wages because it's a more competitive labor market, and there's more money in the economy, so it's inflationary. Now, this curve is like economic theory, and sometimes it doesn't always obey this, right? But as a general rule of thumb, this is like sound thinking, it's sound economic policy, and it influences the Fed's thinking. So what the Fed think, and rightly so, is that if jobs are falling, then that's disinflationary. So what you need to look at here is if we see later on in the session, right? Where am I? If we see later on in the session, lots of disinflationary forces, so say it comes in below minimum market expectation, below 9 million, right? And the job quits are increasing above, 3.851 million, etc., then markets think, aha, jobs are weakening, that's disinflationary. You'd expect yields to fall on the dollar to fall, and you'll expect upside in gold. Now, gold can be tricky at the moment, so I'd only be expecting a short-term opportunity, but a big miss in the jobs, I don't expect upside in gold. We've also got Fed speakers coming in later, so it would be a short-term trading opportunity. Similarly, on Thursday, we've got ISM services data out for the US. Again, that's going to be important. If that ISM services data comes in very low, then it will show that the US economy is starting to slow in the services sector, which has been doing so well. Okay, so if you see the, it's not services, sorry, it's the manufacturing PMI. This is less important, actually. Sorry, I made a mistake. I thought it was the services PMI. This is not so important because markets are expecting this to fall anyway. Okay, you can see that manufacturing has been dropping, and it has been dropping over some time. They will look at the employment component. That will be important. So a big drop in the employment, you'd expect that to be dollar weakness, gold upside. And if you saw a big miss in the data, that's kind of expected. So it would have to be below 45.5. But if it's a weaker print, then you expect that to be mildly dollar negative. But, and this is Salman's point, an excellent point, and it leads us into it nicely. What's the progress of the debt ceiling talks? Well, the progress is basically there, but not quite. So if you look at the issue, what's expected, Salman, is some hardliners are expected to vote against the deal today. But expectations are that the bipartisan alliance will get the deal through. There is some question marks about how it can go through Congress, and some people are thinking, well, it might be rejected the first time. So what that means, Salman, is the debt ceiling talk deal looks like going through and is almost universally expected to go through, but that doesn't mean to say there can't be some drama as we head into the end of this week. So equity markets are lower, and that's mainly on global growth worries. There was some very weak Chinese data out, well, weaker than expected Chinese PMI data out overnight. That's weakened sentiment throughout the session. You see S&P 500 just pushing through that 4,200 level, trying to make fresh lows as we speak. Dow down, NASDAQ sort of putting in some lows of the day. European stocks negative, China 50 all negative. Looking at the volatility index, you can see that the VIX is just pushing up towards highest levels of the day. High volatility, you typically expect a drop in the underlying asset. So with the VIX rising, you'd expect stocks falling. That's exactly what we're seeing. So debt ceiling talks progress is good, but there could still be some drama. So it's quite tricky to trade because there could be some spiky price action. It should all be done, but it's a political game, Salman. So look out for some, hot headlines. Oh, the deal's not going to go through, the deal is going to go through, becomes very choppy and confusing to trade. Bottom line, should go through. If it doesn't, then there'll be a huge problem, and you expect the S&P 500 to drop 10-15% if the deal didn't go through. But as I said, virtually everyone is anticipating that to happen. So if the deal does go through, then what I'd expect is the focus to go back onto the dollar and the focus to be on monetary policy. Now, what I'd expect then is if the deal does get through, I would expect dollar weakness. Why? Because the risk-off trading on the debt ceiling talks can allow the dollar to fall. And I'd expect euro-US dollar upside and gold upside, because I'd also expect yields to fall as well. Now, looking at the dollar, the only thing I say, got some stiff resistance up at that 105, 105.50 level. So I wouldn't be surprised if we did see price move into this level technically, but medium term, I am expecting the dollar to weaken. But Salman, if we see risk-off trading on global risk worries, then the dollar can keep gaining. And it's those global risk problems that have been weighing on commodity markets, WTI, Brent crude. investors and traders are concerned with the outlook worsening for China, where's the demand for oil going to come? We are reaching some pretty decent support level for oil, but there's some big concerns out there at this point of time. So that's my outlook there. Finally, I've got a few minutes that I want to share with you, just payrolls. Now, the way payrolls works, remember that Phillips curve that I showed you? It's exactly the same. Good jobs data is seen as inflationary. Weak jobs data is seen as disinflationary. If it's disinflationary, so bad jobs, you'd expect the dollar to fall, 10-year yields to fall, gold to gain, right? You'd also expect the S&P 500 to fall, but I'm leaving equity indices out of the equation at the moment because we've got the debt ceiling talks going on at the same time. That makes it tricky. So if this comes in very low, so say the headline comes in below 190 expected, participation below 62.5, unemployment below 3.4, average hourly earnings below 4.2. Say we see that, then I would expect, and weekly hours below 34.3, then I would expect gold upside, dollar downside, 10-year yields lower. You'd expect to see euro US dollar upside. If the jobs data is very, very, very strong, so above 230,000, unemployment rate, if that's falling, 3.4%, in other words, less people are unemployed, and you see the headline coming in at 253,000. If it's strong like that, I'd expect dollar strength. That'll be euro US dollar downside and gold downside. And remember, markets are sort of expecting US labor data to start fading. So if it doesn't, if it comes in very strong, it will be a surprise. So that's something to look for Friday. So there's quite a few things. Fed speakers out, debt ceiling talks. Once the debt ceiling deal gets done, trading equities becomes easier. For now, it's just a little bit tricky. But the dollar and the 10-year yield reaction has been pretty consistent recently. So hopefully that relationship will stay the same. Manage risk as always, particularly when you're trading your own capital. You have to. There's no such thing as a surefire event in markets. Markets can always surprise us and do things that we're not expecting. But that's what we can reasonably expect heading into the next few data points. Don't forget, on Monday, I will be back. Yeah, how does debt ceiling make an impact on the equity market? Right, I'll explain how it works. Right, so the debt ceiling deal, basically, Haroon, it is the limit to how much money the US can borrow. And they put a ceiling on that so they don't borrow too much money and they don't put their economy under strain from too much borrowing. If they don't get the debt ceiling done, right, and they fail to do that, that means that in theory, the US will default on paying its bonds. If a country defaults on paying its bonds, it means it's an unreliable country and investors will be very reluctant to lend to it. The US at the moment, the US Treasury is seen currently as one of the most reliable investments you can make, because what are the chances of the US government going out of money and becoming bankrupt? Now, of course, those of us who are experienced in trading know that unexpected events can and do occur. So there's nothing that's 100% certain in life, is there, apart from death and taxes? But, and if you're wealthy enough, taxes aren't necessarily inevitable, but death is. We can't avoid that. However, the US Treasury bond is seen as one of the most reliable investments you can make. So if the US default, it means there's a massive drop in confidence in the S&P, in the US government. So that would mean a sudden drop in US equity markets. It would mean that the dollar would fall suddenly, but then, Haroon, what you might find is global markets become so worried that they actually start buying the dollar, because the dollar gains in a risk-off market. So let me show you, there's this relationship to have in your head. If you don't know this relationship, This is one for you to know. It's called the dollar smile theory. And this was a really helpful thing by an analyst. I think it's, here we go. So basically the dollar can gain as a safe haven, and it can gain when the US is outperforming the rest of the world. So when you see the dollar, if there's a big run to risk, if everyone's worried, then you might see the dollar gain. So what you could see on a debt ceiling deal not going through is the dollar suddenly sinking and then suddenly gaining. I'd expect there to be a big bid into bonds. Exactly what happens to US treasuries could be confusing. You might actually see treasuries sold off initially, yields surging higher, and then dropping lower as they're bought. So you get some very confusing price action, and you might see gold gaining significantly. I have to say, if the debt ceiling deal did result in a default, it would be very difficult to know 100% what would happen, but I would expect S&P 500 to fall 10-15% on that kind of event. Eamon, will this be on YouTube? It should be. Please message support to make sure you get this detail. Folks, it's been a pleasure. And don't forget, I will be back here on Monday for the live market analysis, where I'll look at the events coming up and we can do another recap and just see where market's at, and hopefully we'll get some clarity on that debt ceiling deal. And don't forget, you can ask questions, anything that you got, and we'll take it all again next week. I do hope you have a very good rest of your session. Thank you very much for attending, and I look forward to being back here again on Monday. Yeah, you're welcome, Haroon and Eamon and Salman. Thank you very much for your comments. Gabrielle, always a pleasure. Take care and enjoy the rest of your session. Thanks everyone now. Goodbye.